Chapter 10 The Carnival Barker. Angelo Mosillo had long had a conflict attitude toward subprime lending. On the one hand, he looked down his nose at the likes of Americas and Ronald Arnold and didn't want Countrywide or himself to be viewed in the same light. There is a very, very good, solid subprime business, and there is this frothy business, he once told inventors. It's very important that you understand the disciplines the Countrywide has. On the other hand, Mozilla couldn't bear to see Countrywide's market share eclipsed by the subprime companies, and market share remained his obsession. By the middle of 2003, he was promising inventors that Countrywide would get our overall market share to the ultimate 30% by 2006-2007. At the time, its share of the mortgage market was a little over 10%. Mozilla would later frame the choices Countrywide faced in stark terms. Americas changed the game, he said to a friend. If you had said, nope, I'm not going to do this because it's not prudent, you would have had not tell shareholders I'm shutting down the company. The reality, however, was never that simple. Mozilla had created a company that had the desire to be not just big and good, but biggest and best embedded in its DNA. Taking a pass of a large segment of the business wasn't Countrywide's style. And then, as subprime 2 gained steam, Countrywide was increasingly driven by internal divisions. The way those conflicts played out may have helped influence Countrywide's future course every bit as much as America's uncatchable thirst for subprime lending. By the early 2000s, Angelo Mosillo wasn't remotely the hands-on manager his frequent CNBC appearances would suggest. This wasn't by choice. He was struggling with a variety of health issues. He had spinal cord problems so serious he had trouble walking at times, according to one person who knows him well. He had neck surgery, back surgery, and another elective surgery, which went badly, the same person says. And all acquaintances who hadn't seen him for several years was shocked when the next saw Mosillo. He looked like an old man, he says. David Loeb, Countrywide's other founder, wasn't around either, having retired as president and chairman in early 2000. He died of pneumonia in 2003. Lev was in some ways the invisible founder, yet he had played a critical role in Countrywide's success. Access to capital, the sale of loans in the secondary market, the management of interest and credit risk. These were the important but low-profile aspects of the business Love focused on. Loeb's departure hadn't been entirely graceful. As he got older, his behavior became more erratic. In July 1999, for instance, the news broke that Lev had sold 1 million shares of his Countrywide stock. High-ranking executives at Publicis-owned companies are never supposed to sell stock without first clearing the sale with the legal department and informing the rest of the management team and the board. Loeb had done neither. When one executive called to ask him why he had sold the stock without telling anybody, Love just chuckled. After Love left, Mozilla seriously entertained the idea of selling Countrywide. There were lots of potential suitors knocking on his door, and he hired Goldman Sachs to find the best fit. Although Countrywide came close to selling to a big British bank and to Washington Mutual, both deals fell apart. Even without a sale, there were plenty of executives internally with the ambition and skill to run the company. Countrywide's core group of executives had joined when the company was young and small. Like Mozilla, most of them lacked an Ivy language pedigree, but made up for it with a combination of business savvy and fanatical work habits. Most of them had that same chip on their shoulder toward the financial establishment that Mozilla had. That attitude was ingrained in the culture of the company and was a big part of the reason why Countrywide was always striving to outdo the big boys, even after it had become one of the big boys. For Countrywide's top executives, that deep state need to prove themselves never completely went away. Chief among these executives was Stanford Courtland, a graduate of California State University, not right, who was hired by Countrywide in 1979 after spending the early part of his career as Countrywide's auditor. Courtland had an intense, bookish demeanor and a slow, almost hesitant way of speaking that served to mask his deep emotion and strong will. In 1995, he became the Chief Operating Officer of Countrywide Home Loans, the prime mortgage division that had always account for the bulk of Countrywide's business. 4 years later, Kurland became the division CEO and joined Countrywide's board. In 2004, he became president and chief operating officer of the parent company. To the employees, he was as much the boss as Mozilla. It was always Angelo and Stan want to do this, recalls a former executive. Kurland was the one who took on the task that Love had always handled, making sure that Countrywide's increasingly intricate plumbing worked perfectly. This was no small task at a company that was funding tens of billions of dollars worth of loans every month. He was the inside guys, the numbers guys, the operation guy, says a former analyst. In 2000, PaineWebber analyst Gary Gordon wrote a report celebrating Countrywide's wonderful discipline. That discipline was very much Kurland's doing, and he took great pride in it. He'd later tell people that while he was there was never a single issue. He was right. Other mortgage originators occasionally had trouble with funding or the sale of their loans. Countrywide never did. Kurland also pushed Countrywide to diversify. He wanted Countrywide to be one of the most admired financial service providers in the country, not just a big mortgage maker. To that end, Countrywide bought a bank in 2000. Because the bank was regulated by the Office of the Comptroller of the Currency, Countrywide itself became a bank holding company, which was supervised by the Federal Reserve. Kurland used to tell people that being under the supervision of the country's two most important bank regulators gave Countrywide extra credibility. The purchase of the bank also forced Mozilla to leave the board of another bank, a supreme lender called IndyMac, based in Pasadena. IndyMac, which would be taken over by the FDIC during the financial crisis, had begun life as Countrywide Mortgage Investment, funded by Mozilla and Love. It was a real estate investment trust, or REIT, that served as an outlet for Countrywide's so-called jumbo loans, the ones that were too big for the GSEs to buy. R E A this pay out most of their profits as dividend to their shareholders. Starting in the early 1990s, it began to aggregate loans from other lenders and turned them into mortgage-backed securities. It also began to originate its own Alt-A mortgage. In other words, the company was starting to compete with Countrywide. Despite the growing conflict, Mozilla stayed on the board, as did Love, exercise stock option, and collect some of the company's rich dividends. His son, Mark, began working there in 1996, and when Mozilla finally left the board after Countrywide bought a bank, it was because he had no choice. IndyMac also owned a bank, and bank regulation don't allow anyone to serve as a director on two bank holding company boards. When Mozilla stepped down from the board, IndyMac forgave an outstanding $3.3 million loan and paid him another $3.6 million to cover any tax he might owe on his stock option. Taking the money was an outrageous move, and to some at Countrywide, I think that money was starting to matter too much to Mozilla. In 2000, he owned 2.8 million shares of Countrywide stock, including option, and would take home 6.6 million in compensation, a number that would rise to 10.1 million by 2001 and 23.6 million by 2003. Yet he wants more. There are CEOs of companies to whom the most important thing is if they made more than the next guy, says someone who knew him well. Mozilla was getting caught up in all of that. If Stan Corland was in charge of Countrywide's plumbing, a very different kind of executive was in charge of producing all of its lawns. His name was David Samble. He had joined Countrywide in 1985 and become its head of lawn production in 2000. He was named Chief Operating Officer for the Home Lawn Division in 2004. Like Corland, Samble had gone to California State University, not right, and had worked briefly as an accountant. For many years, the two men appeared to be friendly. They were both highly intelligent, proud men who care deeply about countrywide's standing and its market share goals. About Sambol, a former executive says he bled countrywide, but there the similarities and Sambol was a super aggressive salesman, very much in the Mozilla mood, though he lacked Mozilla charm and warmth. He did not always make a good first impression. His style was one of attack, says a former executive. He would attack everything around him that didn't report to him. He would be relentless and very convincing until you challenged him with facts. But when you call him out, it never bothered him. It rolled right off his back and he was on to the next thing. This aspect of Sambol's character gave rise to an internal nickname, Teflon Dave. Another firm executive who was a fan of Sambol says he loved the details, he loved knowing the details, and he loved putting people through the wringer to see if they knew the details. People also made fun of his dictatorial nature. Other executives would pretend they were Sambol and say to each other, "You don't understand. You're not capable of understanding. I see all of the colors of the rainbow." Inside Countrywide, it was very apparent that Sambol was all about building his own kingdom. As a former executive puts it, he was dismissive of everything that he hadn't personally created. And while one firm executive says that Sambol did care about risk above all, Sambol wanted to win. There was a clear mentality from his organization that these guys are outcompeting us. We've got to do this. We just lost another loan, recalls a former executive. Soon after taking charge of the sales force, Sambol made several changes aimed at putting Countrywide on a more even footing with its supreme competitors. The most important of these was to the compensation system. Instead of taking home a flat salary, loan officers would earn commissions based on volume, according to the American banker. There was always friction at Countrywide between those who worried about risk and controls and those who want to sell more loans. But for a long time, the friction was manageable, maybe even healthy. Really great organization have friction, says another firm executive. But friction can become cancerous. For Countrywide, the friction started to become a sickness in 2004 when the Federal Reserve began to raise interest rates. Normally, rates increase signal that it's time for mortgage originator to pull back on loans production. But in this new world, loan production did not decline. Those like Cortland, who worried that higher rates brought increased risk of default, felt as though they were trying to hold back afloat. In higher moments, they began to joke that they were becoming the CNOs, the chief no-sense officers. Cortland complained to confidants that some days they felt his role was increasingly being relegated to that of the no guy. The people who are propelled upward in many cases in corporate America are the guys who said yes to an idiot at work. He later told a friend, the guys who said no to a big failure. There's no list for that. That's why we end up with bubbles. When Countrywide had first moved into subprime lending back in the late 1990s, Cortland and Mozilo had both believed that the market was moving toward risk-based pricing, and the lines between prime and subprime were going to go away. And they convinced themselves that Countrywide would establish standards that would keep the truly troubled borrowers away, while capturing the more creditworthy subprime borrowers, those who were just a step below prime. Initially, the company was very careful. Cortland issued 3 rules for subprime lending and Countrywide, according to several firm executives. First, all of its subprime loans had to be sold, by which he meant the entire things, including the residuals that most subprime companies held on their books. Second, the borrowers had to either make a 30% down payment or get mortgage insurance to cover the first 30% of the loan. Finally, Countrywide couldn't offer any subprime loan products that had a higher probability of default than an FHA or VA loan. These rules, however, seemed to constrain the company less and less as time went on, and with wherever reservation Mozilo had about subprime lending seemed to fade the bigger the market got. Within a few years of making subprime loans, Countrywide could offer us astonishing 1,080 different products. In 2004, the American banker accused Mozilla of sounding like a carnival barker, as he lists some of them. We have ARMs, 1 year ARMs, 3 year, 5 year, 7 and 10 year. We have interest-only loans, pay option loans, zero down programs, low or no doc programs, fast and easy programs, and subprime loans. Sample told inventors that it's our intent to carry every product or program for which there is reasonable demand. If your customer can legitimately qualify for loan anywhere else in the US, they'll qualify at Countrywide. In a complaint, the SEC later filed against Mozilla, Sample, and former CFO Eric Sieracki. The agency alleged that Countrywide referred to this as its matching strategy. If a competitor offered a loan product, Countrywide will watch it. Besides, with Wall Street willing to buy anything, mortgage issuers willing to warranty anything, and estimates about the probability of default open to assumption, Kurland's rule could be rendered basically meaningless. Indeed, one former executive says that if he could go back and do one thing differently, he would look at the models about how loans were supposed to perform and say, I'm not going to believe them. We had meetings where I would say, are you sure we're comfortable with that? Says this person. And they will write in the quants, and so the matching strategy came to mean that Countrywide repeatedly launched its white lines for both the loans its own sale force originate and the loans it purchased from other, according to the SEC. Other subprime companies, for instance, adopt a loan strategy called risk lawyering, in which 2 or 3 different risks, no doc, adjustable rate, credit impaired borrower, were wrapped together in one loan. These were risks that were never going to coexist, and blending them greatly increased the chance of default. Yet, since Countrywide's competitors were making risks larger loans. Countrywide made them too. It was madness. Subprime one was just really high rates for borrowers with bad credit, says Josh Rosner. That's different that the loan itself being a bad product. When you are the biggest, you have a responsibility to not give credibility to bad products, whether you're Countrywide, Fannie, Freddie, or any of the big mortgage lender out there that were doing this, says a former Countrywide executive. Countrywide did just the opposite by mimicking the products of competitors. No matter how dangerous it gave them an imprimatur they didn't deserve. There was a final problem with the company's subprime wireless. If a borrower couldn't meet the guidelines, Countrywide would try to make the loan work anyway. This was not some rogue effort by aggressive branch managers to sidestep the rules. It was the rule. Countrywide called it the exception pricing system. Every lender had some version of this, but according to the CEC, Countrywide liberally used its exception policy for loans that didn't fit into even the law's net guidelines. One former Countrywide executive says that Mozilla told the sales force to listen to Sample, that Kurland in its complaint, the SEC corroborates that in part, saying the company's rules about a kind of subprime loans known as an 80-30, the customers took out two loans in order to borrow 10,000% of the money needed to purchase a home, were ignored by the production division. In 2005, John McRae, Countrywide's chief rights officer, wrote in an email to Sample, as a consequence of a strategy to have the widest product line in the industry, we are clearly out on the frontier in many areas. The frontier, McMurray added, had high expect default rates and lows. Those in the industry could see the change, even if Mozilla still refused to acknowledge it, says former industry executive. Ronalds thought he was a hypocrite. It was an odd thing, Countrywide acting holier than thou. Countrywide was in the same game, but to the outside world, the picture couldn't have seemed more glorious. By the end of 2004, Countrywide had leapt in front of Wells Fargo to be the nation's largest mortgage company. It originated a stunning 3,063 billions in mortgage that year. A year later, Countrywide originated almost 500 billion in mortgage. Samble and other executives had taken to telling investors that Countrywide expect to generate 1 trillion worth of mortgage by 2010. They were halfway there. It was pointless to expect Washington to do anything to stop the abuses that characterized Subprime 2. In addition to Ned Gramlich, the only people in Washington who seemed to care about the issue were Senator Paul Sarbanes and Sheila Bair, the Assistant Secretary of the Treasury for financial institutions during the first few years of the Bush administration. But as a Democratic senator, Sarbanes had no leverage in the Republican-dominated Senate, and Bair, a moderate Republican from Kansas, didn't have much leverage either, realizing that pushing for new regulation was futile. She tried to get the industry to write a voluntary code of conduct for subprime lending. She chaired a big meeting that included America's Citibank, J.P. Morgan, Countrywide, and others. But that idea soon petered out. The problem, says one former regulator, is that they were all making too much money. So it was left to local officials to try and stop the abuses, and try they did. But at every level, those who took on the lending machine found themselves stymied by lender lobbying and federal bank regulators who actively and successfully sought toward local officials. It would be hard to imagine a more telling example of who the nation's bank regulators had become captive to the institutions they were charged with regulating.